Hello and welcome to the FintechWire Innovators Podcast. My name is Ed Medina and I'm editor of FintechWire. We're talking insurance in today's episode. The insurance industry is facing a period where claims costs are outstripping premiums, and this is leading to an industry average combined ratio of more than 100% for 2023. Process efficiency alone is not enough to make up the gap, so insurers are looking for new ways to bridge that gap. Applying AI to policy and claims challenges is one place to start. To help us understand how insurers are addressing this challenge, we've invited Jeremy Jawish, CEO and co-founder of Shift Technology. Shift delivers AI decisioning solutions to benefit the global insurance industry and its customers. The company's products enable insurers to automate and optimize decisions from underwriting to claims, resulting in superior customer experiences, increased operational efficiency, and reduced costs. Jeremy, it's a pleasure to welcome you to the show. Tell us about yourself and Shift, please.
Yeah, so I'm Jeremy Jawish. I am the CEO and one of the founders of Shift Technology. So Shift is an AI platform dedicated to insurance, to the insurance industry, and we provide our customers an AI platform that helps them to take a better, faster, and more accurate decision through the life cycle of their customer journey. And today we've been, heavily invested in the U.S. market, processing more
Hello
than
and welcome
60% of the policy and claims data on a daily basis.
My name is
of the
Ed
insurance
Medina,
industry.
and I'm editor
And
of FintechWire.
we're really passionate about helping our customer to fight the combined ratio problem we're seeing on the market.
Excellent. Also joining our discussion today is veteran insurance industry consultant and thought leader Jeff Goldberg. Jeff, welcome to the show.
Sure. So I'm Jeff Goldberg. I have been in the insurance industry my whole career, but that includes all sides of the industry. I started out writing software on the vendor side before managing systems, and then eventually as an IT executive at a number of insurance companies. And then for the last 15 years, I have been an industry analyst, where I've been just talking to hundreds of insurance companies and vendors about their strategy and how that aligns with the business needs of the day.
Great, guys. Welcome. So for our first question. So Jeremy, you mentioned the combined ratio. What is driving the combined ratio crisis, and why are insurers having such a hard time with this?
Yeah, that's the reality of the market today, where we're seeing, I'm going to call it a combined ratio crisis that is one of the toughest in the last century. And it's driven by, three main things. I know there's a lot of, articles and press around it. So it's worth mentioning it as a condensed into three categories. The first one is macroeconomic factors, where, we're seeing that inflation and the labor shortage is driving the claims, the average claim amount up in a very drastic way. The second category is environmental issues with, a big increase in natural disaster, fires, floods, all the different, environmental problems that are in an intensity that we've never seen before. That's also driving the claim loss higher. And then the last one, which is premiums that, carriers are not able to increase according to that for lots of reasons. The first one is because of regulation, and also because they need to make sure they don't lose their customer in their portfolio. So these three combined makes it an unprecedented crisis in combined ratio, and we're seeing insane numbers that nobody would thought about during the COVID crisis or before that. And I think the conjunction of these three makes it a unique situation right now, a badly unique situation right now.
Thanks, Jeremy. And Jeff, what do you think?
One of the things that makes this particularly difficult for insurers is that all their predictive models are broken, right? The insurance industry has been based around looking at historical data to predict what costs will be in the future. And that's not working as well as it used to be. Historical data is not acting as predictably. And insurers need to find new ways of using current data to make decisions about what's going to happen or what costs and risks will be rather than using historical data to make decisions about what costs and risks used to be.
Thanks, Jeff. So, speaking of technology, insurance companies have tried to respond with automation. So, Jeremy, is this not enough?
If you look at the effort you need to put, I'm not saying we should not invest in automation, but the effort you need to put in, investing in operations and automation compared to the benefit you're getting on the combined ratio, at some point this investment is stepping out because there's so much you can do. And on top of that, if you overinvest in it and you start over automating your process, you can also start introducing new challenges because you won't be that accurate on is the claim is suspicious or not. You won't be that accurate on the subrogation determination. You won't be accurate on the evaluation of the claim, and you end up introducing even bigger problems because 1 point of or 2 points of claim loss that you're missing because you're overly investing in automation is much, 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 much harder to make up in being more efficient on your operations. And this is where our philosophy is that automation is very important for, I believe, more customer service and making sure that your customer don't go through a huge painful process to get their claim fixed. But a lot of attention should very quickly be turned to the claim loss itself, where we think that they should put much more investment there.
I see. Where does artificial intelligence come into all this?
Our market right now is in need of accuracy, and all the effort that's being put on automation, I think the same and even more effort should be put on, are we taking the right decision even if it's not automated? Are we giving the right tools to our experts that are sitting there and handling thousands of claims a year because they're being pushed and being having under pressure today to take faster decisions because we need to be more efficient, we need to reduce our cost of efficiency. So these people that are expert and have limited work hours, they need to be armed with the right predictive model to tell them, look, the machine figure out that maybe you should look at that and not spend your time trying to figure out where you should look at. Or the machine says you can just sell the claim now without overthinking it because it is business as usual. And
Yes.
the exciting part of it is that our number of experts is going down because the market is more complex, the environment is more complex, and we are a shortage of labor. And on the other hand, the AI is able now to pick up more and more data and also to pick up more and more insurance reasoning, to help these experts to be more efficient. And the sentence we like at Shift is be there more for their customers, which is initially their main job.
Jeff, what do you think about AI?
So I'd like to jump off a few things that Jeremy has said. And first of all, we're talking about automation, we're talking about analytics, and we're talking about AI. And while all three of those things are very closely intertwined, they're not the same. And I think that insurers have a almost cultural resistance to the word automation. There's a real investment in their own people. They get scared. Not scared is the wrong word. They don't like talking about automating people out of jobs. But what Jeremy is talking about is making people smarter and better in their decision making, letting them focus on the harder problems rather than the ones that are more easily resolvable. And I think that's really key here. You could, as an insurer, invest in analytics and AI and not automate anything. You just use it as an augmentation factor that your humans use in their manual decision making. That's not automation. It's just giving them better data and helping them do their job better. And what I see is that is way more common. It's for pretty much all insurers except for direct insurers who have a more natural tendency to try to do true straight through processing. And so that's really key here is thinking as an insurer, where is your balance lie? How much do you actually want to augment your people versus making decisions around automation?
Thanks, Jeff. So, Jeremy, to quantify this, can you help us understand some of the results that you see with AI and related technologies?
Yeah, so this is where I think the numbers become really interesting because, from our research working with, you know, majority of the top 10 carriers in the US, for every 1,000 claim analyzed using AI, we're able on average to stop $60,000 of fraud. So for every 60,000 of, incremental saving for 1,000 claims. And when you compare that to, when you do the math for 1,000 claim, how much you can save by being more efficient and automating, it's a totally different picture. And this is where when you do the math, you know, when you scale that to millions of claims, you realize that there's a big bucket of investment you can do by taking better, more accurate decisions, and impacting $60,000 per 1,000 claim. That is, I think I'm going to say more low hanging fruits, and it becomes low hanging fruit today because of the AI and because we're able to process a ton of data much, much, much more easily than 10 years ago. That I think insurers and carriers are underestimating. And it's not just it's not a magic wand where like, oh, I'll send my data to an AI provider, put AI on it, and then suddenly I'll detect thousands of claim I should not pay or subrogate differently, or I did the mistake on the liability. It takes a real transformation in terms of mindset, which sometimes is harder than a change in terms of investment or operation. And but today there's a big part of the combined ratio, and here we're talking about several points, several percentage of combined ratio that should be addressed by putting AI within their processes to take better decision. And I'm insisting on that because not just automating and reducing staff, but helping augmenting the staff to take the right decision that can have a huge impact on the combined ratio.
Jeff, what do you think?
I think those numbers are great. One thing I will say specifically around fraud and using AI and analytics for fraud is that the attitude of the insurance industry is a little more collaborative. It's for the good of the insurance industry to prevent fraud. Predicting underwriting risk and making the best underwriting decision is more competitive. But when it comes to fraud, it's like casinos sharing the names and pictures of card counters. Except I personally think this is even more culturally relevant and important. And frankly, some fraud is just by its nature. Catching fraud rings, right? It is a collaborative effort and requires some sharing of data. And the reason I bring that up is I think it is important for insurers to have their own fraud solutions and their own teams that are reviewing things. But participating with third-party fraud detection is essentially a community good that makes the whole industry better.
I see. Jeremy, from your perspective, how does AI help insurers protect against things like premium leakage and fraud?
Yeah. So I talked a lot about taking better decision on claims, but today we're able to have a significant impact on our customer at the underwriting level, and this is something that a lot of carriers were looking at. It's like yeah, it could be interesting theoretically, but then now with how much the wrong risk is costing insurers, they realize that there is also much more to do on the underwriting side and risk side. It's becoming so expensive to underwrite the wrong risk that this is the moment where they need to really change the paradigm and really look at how they can address that. And one way of doing it is like, is the risk that I'm underwriting right one regarding potential bad combined ratio? And we're seeing that if you understand well the claims data and you're able at the front end at the underwriting process be able to cross-reference it with a lot of external data and say that this is the risk you don't want. We realize that on part of the business where we catch, a group of policies that should have not been underwritten, or even sometimes some agent, behavior that should be stopped. This subgroup of risk are having in some cases 500, 600 higher combined ratio than, the average risk you want. And this is something where, it was on small pockets, insurers were not really looking at it. But today, with the environment we live in, where, dollar count much more today to consumer or to businesses than before, and, a wrong risk underwrote now costs much more, it's having a significant impact on the portfolio. And this is once more another area where we're able to have a significant impact when we are able to carve out, part of the risk that are 600, 700% higher combined ratio, and having a real significant impact on the total portfolio, rather than going and finding a 0.5% of optimization in the operation on the underwriting process, where you go through a huge change and big pain, and lower the morale of your whole team for 0.5%, where you can get 1% by really infusing in a more advanced way AI within your processes.
Thank you, Jeremy. Jeff, can you talk about some of those underwriting risks?
I think that all underwriting risk has risk, right? You don't sell an insurance policy where there's zero risk. If there was zero risk, then that person doesn't need insurance, and it would be you shouldn't be selling it to them, right? And so I think what is happening here is, but there's good risk, meaning we as a company think it's fairly low that we'll have to pay out a lot of money, and then there's these very bad risks that you're talking about. But then there's everything in between. And if you can identify those really bad risks and get them off the book, and you can speed up the decision making around the good risks, even though that doesn't really have an impact to your combined ratio because they're good risks, you're just speeding it up. It allows the insurer to focus, the people at the insurer to focus on the things you want, which is those risks in the middle. And as an insurer, you're always taking risk when you sell a policy. And the better you're doing with automating or augmenting the sort of good and bad cases, the more you can actually make decisions on, well, do we want this middle risk? And the answer might be yes. The answer might be no. The answer might change over time. Maybe you say, well, we're willing to take some of these middle risks until we hit a certain percentage of those, and then we don't want any more. I think so many insurers focus only on one policy at a time, rather than actually being able to make that kind of calculated decision based on their overall book of business as it stands today. But until you have this kind of automation, augmentation, and analysis, it's really hard to get to that level, that ideal level of decision.
Thank you, Jeff. Before we wrap up, I'd like to talk about subrogation. Jeremy, can you talk about the opportunity that AI offers in this area?
Yeah, so trying to simplify it, what we do on our side for subrogation is detect missed opportunities of subrogation. When the claim should not be paid by our carrier, but should be paid by somewhere else. I'm going to make it very broad, right? And, we know that every claim is being looked at by handlers, but, humans are not perfect. Data sometimes available is not, always there at the right moment. And, our results and our research point out that there is going to be a big number, but there's 7% of the claim loss that's an opportunity to go and find and recover in the subrogation process thanks to AI. 7%. 7% is, like, in some cases, half of the staff that manages claims.
That's a big number. Jeff, what do you think about this?
I'm not going to say much more about subrogation than Jeremy already did, and I think that's absolutely correct. There's opportunities here to make better decisions. What I do want to add is, it actually sounds really similar to claims leakage around reinsurance. The percentage of claims that are not covered by reinsurance but should have been, where insurers have already shared premium with the reinsurer but didn't properly report them to the claims to the reinsurer when they should have, is estimated around 6% of claims. So similar to the number you just used around missed opportunities for subrogation. So just throwing that out there, I think we should be applying the same technology in a similar way to analyzing reinsurance treaties and identifying opportunities for claims that should be covered. But what it comes down to is there's tens of billions of dollars in the insurance industry where insurers are paying out claims, legitimate claims. We're not talking fraudulent necessarily, just it wasn't the insurer's responsibility, either because someone else should have covered it or because, either on another insurer or the reinsurer should have been covered. So that's real opportunity for insurers to have significant bottom line impact without frankly changing some of their fundamental underwriting or core claims decision.
Thank you, Jeff. And thank you both so much for joining us.
Thank
Thanks,
you,
everybody.
Bye-bye.
We release new Innovators podcasts every week at FintechWire, so check back here for new episodes. We appreciate you listening.